Hey everybody, thanks for being on this webinar. My name is Chris Kirkpatrick. I'm the Safe Bet Money Guy, teaching the secrets of the wealthy to the movers and shakers of the world so they can avoid the stock market casino and gamble-proof their life. Now, what we're going to talk about in this webinar is actually one of my favorite things to talk about. It is talking about abundance banking, and I'm actually going to get into and show you how to avoid the stock market casino and how you can actually create true wealth on a 100% predictable basis. So here we go. But before I get into anything, just in case you guys don't know me, just in case it's your first time here or being introduced to me and the company, my name is Chris Kirkpatrick. I was a former international top ranked poker player. I played online. I had a professional sponsorship deal. I was ranked as high as number 64 in the world. And, that may seem a little ironic that I deal with financial security and financial structure at this point in time, being a former gambler. But what I can tell you is that I was a systems person. Everything I did was inside of a system when it came to poker. Gambling was not really there for me. Yeah, I was gambling hand to hand, but in the grand scheme of things, I had a system that said, hey, if you do enough of the right action over a long period of time, you make money. And that's just the way it worked for me. So when I kind of got laid off from online poker because the government in the United States shut it down, I entered the financial industry and I quickly built one of the top teams for a Fortune 1000 company in the entire country. Came in, became a very successful financial advisor in a very short period of time, my first year, in fact, and was promoted, ended up becoming the head of recruiting and development for a region, and built the second largest, fastest growing team in the country in a very small territory, I might add you, in Vermont. And the only person who beat me actually was from Miami, and then close third behind me was from New York City. So pretty cool, to be able to build, in such a small area. It was really cool. So that said, I am a financial security expert now. That is what I focus on. My big passion is because I've seen so many people go belly up. I've seen so many entrepreneurs struggle with their business simply because of the way they deal with their finances. And what I've learned as I've gone through my career, and I'll get into some of this with you in this webinar, is that most of the time it all happens unnecessarily, and it's all because they took on risk maybe when they shouldn't have, or they structured their financial life in a way that made them susceptible to succumbing to downward turns in the market or whatever. So I love helping teach people how to get out of debt, how to build their financial security, how to build their financial foundation. And really what I love is this abundance banking concept, and I'm going to get into it today in this webinar and teach people not just how to build their foundation, but then once they build that foundation, how can they leverage that foundation and push it forward and start creating true wealth from it. And that's awesome. So I've written some awesome books. I've written books on how to build your own asset. I've written an ebook on rebuilding your credit, understanding how credit works in your life, things to manage, and how to maximize your credit to actually position yourself and create wealth in your life. And, as my daughter says, this is probably my biggest claim to fame, is I am the best father in the entire world. Now, that may change tomorrow. She may change her mind, and she tends to do that from time to time. It depends on how good of a day she's having. She is 4.5 after all. So, but best dad in the world. That's my biggest claim to fame out of everything. And so, but that's a little snapshot about me. So let's get into the details now about kind of what we're talking about. So I'm going to go through some really interesting things. I'm going to cover 3 major topics, but one of the things I can promise you is that if you stick through to the end of this webinar, my biggest promise to you is that you will never look at money the same. You will never think about money the same. You will never save the same. You will never invest your money in the same way. Every action you have around money will be impacted from this day forward simply because of the information that you will receive in this webinar. And I know that sounds like a bold statement, but I'm going to cover the history of the stock market. There's a big void in the history of the stock market, in the history of the economy. I mean, we live at this point in time right now where even students who are going through college, getting their degree in economics, are not learning the history of the stock market, are not learning the history of our economy, and are not learning not just what happened, but why did it happen? What factors impacted what happened to happen? And it's scary because we're repeating a lot of the same things. And so taking that into consideration, the next thing I get into is the banking principles. And ultimately, that's a really quick little kind of punchy topic for me to get into, but there's a couple basic principles about banking that you need to understand, because if you understood these principles, and if you understood how you can then take those principles and create your own banking system in your own personal life and leverage those principles to create more abundance in your life, I'm telling you, you can achieve everything that you want to achieve in life by taking less risk, have more predictability, and you get to where you want to go. And you get your money working for you. And that's what it's all about. So let's talk about the history of the stock market a little bit. I know most people right now have a pretty big affinity towards investing in stock, and it's kind of become the default place to save or invest or whatever you want to call it, I guess, at this point in time. But I want to break it down for you and kind of show you why that may be the case, and show you also not just why that's the case, but why it may be hurting you, and why having that mindset, why thinking that the stock market or mutual funds or any of that is the best place to put your money may not be in your best interest. So first and foremost, we break the stock market down into three major periods. And you can look at here that the real rate of return in the Dow Jones Industrial Average, that's what we're covering here, from 1901 to 1979, the real rate of return was just 3.7%. Now that's a scary, scary, scary number. Now, from 1980 to 1999, that number gets far, far greater. That goes all the way up to 14.01% between that time, that range. And right there, most of the baby boomers, that's when they were making their money. That's when they were saving. That's when they were investing. That's when they were creating their wealth. That's when they were really generating their retirement savings. And so that period right there has built this affinity towards the stock market. Now you can see that we had 78 years of period before where it was just a 3.7 average, but from there forward, from 1980 to 1999, it was an amazing period of time. And quite frankly, there was no better place to be than in the stock market, than in mutual funds at that point in time, because, hey, look at the returns. You can't argue with those results. However, from 2000 to 2014, the real rate of return is even worse. It's gone down to 0.54%. And let's talk about why. So I'm a big why person, because if you want to know what's happening, okay, that's okay. If you try to figure out what has gotten you to where you are, that's okay. But it's really hard to learn from the what if you don't understand why what happened, if that makes sense. And so this right here, let's talk about the booming 80s, the booming 90s, this 14.01% a little bit. That right there, folks, I'm telling you right now, in 1980, why from 1980 to 99 did it go up to 14%? Well, I'll tell you right now, a couple factors. In 1980, first and foremost, interest rates were at over 19% in this country. We're at 0.25% as I'm recording this webinar. 0.25%. So what does that tell you? That tells you, well, from 1980 until 2009 is actually when interest rates kind of bottomed out. But from 1980 to 2009, we had an interest rate environment that was getting lower and lower and lower. Interest rates, every time the economy went into a little bit of a struggle, they just lowered interest rates, right? And so that's a factor, because as interest rates go down, that makes the value of things go up, because we're a debt-based society. The second component to that is credit cards in 1980. It allowed people to be consumers, a lot more consumer focused. Our economy went from being a producing society to a debtor society. That's when the whole transition started taking place. Is credit cards before the late 70s didn't even become commonplace. They were really hard. The national credit card network didn't even exist in full force that we have it today until the early 80s. So think about that, right? We all think about like what's holding people back. Well, 33% of people's incomes right now are going towards servicing debt. That's something we never had before. Well, that's hurting us today, but you can enjoy the benefits of that debt for a period of time without really suffering the consequences. And that played part in the 80s. Now, the other element that really benefited the 1980 boom to 1999, the 80s to 90s boom, is the fact that 401ks were created. that we have the ERISA was created in the mid 70s. It's a retirement act that was passed. And what I can tell you about this is that 401ks were created, IRAs were created in the late 70s, and 403bs and IRAs, although those were created in the late 70s, they didn't really go into full force until 1980. And right there, what did that do? That took the average everyday person and got them out of whatever they were doing and put them into the stock market. 401ks were created, boom, everybody goes into the stock market. Everybody tries to defer taxes. Everybody tries to, it was a great thing for a very short period of time, and it created a bubble because, listen, in 1950, less than 2% of people in this country owned common stock. All of the sudden, in 1980, all these people were diving into the stock market, buying mutual funds and stocks and all that stuff. And so what does that do? That creates a boom. So after 1999, we had the dot-com bubble. But after that period of time, the market's been constantly trying to correct itself. It's been struggling, and they created the market busted in 2000. And what did they do? They inflated it with a housing bubble, right? And then the housing bubble busted. And so what are they doing now? They're trying to print money to inflate it. And so I promise you the housing bubble 2.0 is coming. I'll get into that more later. But these are the major periods of the stock market. And you can see that while it's very common for baby boomers to love the stock market because of the results they had during their production years, the reality is that if you look outside of that one little 19, 20-year window, the results are not that good. And I just want to show you, this is just a graph of it. Now, I want to talk about the fact that, I just showed you the real rate of return. Now, you're probably going, oh, that sounds way too low. There's no way that's true. Well, here's what I'll tell you. You haven't ever been sold on the real rate of return. You've been sold on the average rate of return. If you've ever talked to an advisor, if you've ever talked to an insurance agent or a stockbroker or anybody like that, they've been telling you what the average rate of return is. And what they do is they say, hey, listen, yeah, the market's going to be up, it's going to be down, but the bottom line is over time, the market's going to average 8%, right? And so my question is, why do they come up with that number 8%? Well, I'll tell you. From 1925 to 2013, that's what you're looking at is this graph. This is indicative of an 8.36% rate of return in the S&P 500. So the reason I'm saying that is because the S&P 500 index is one of the most stable stock indexes in the entire world. Now, what this graph is showing you is saying, yeah, there's ups, there's downs. Most stockbrokers or advisors will tell you that, yeah, it's going to go up, it's going to go down, but overall, it'll average 8.36%, so let's just leverage it out. Now, what you see here in the gray, that right there is saying, okay, let's get rid of the ups, let's get rid of the big 30% gains, let's get rid of the negatives, and let's just average it out to 8.36% like we have. Well, this shows in 1925, if you'd given me $1,000, right, let's say I had a time machine, and I said, hey, listen, I just came back from the future, and I saw that the average rate of return is 8.36%. Yeah, sure, there's going to be good times, there's going to be bad times, but I know it's going to be an average of 8.36%, and I've done the math. And if you just give me $1,000 here in 1925, that by 2013, that $1,000 will be worth $1.268 million. So let's just call it $1.25 million, right? Are you going to take me up on that? Most likely, the answer is yes, right? I hope. If I like turning a little bit of money into a lot of money, but the question is that the reality? Well, the answer is no, because the average rate of return is simply a lie, and I'm going to show you that in the next slide, how and why that's the case, but it is simply a lie. Now, if in fact I told you you'd get $1.25 million, but the actual performance with no fees only got you to $235,000, you're not going to be too happy with me. But it gets even worse, because when you add in 1.5% fees, 1.5% fees, it takes your whole complete wealth potential all the way from $1,268,000 all the way down to $64,000, right? That's only with 1.5% fees. And if you know anything about fees, I'll get into it a little bit later. That's actually lower, about 25% lower than the average fees out there in the world when it comes to managing money. So that, guys, is this picture says a billion words. This is everything you need to know. The average rate of return, I don't care. I can give you nice, pretty graphs, nice, pretty pictures that'll tell you can go where you want to go if you just average it out. But let's get into why that's not the case. All right, so first and foremost, basically, how is this possible? You're probably wondering, You're probably wondering, how have I been told this my whole life? How have I been banking on this 8% average rate of return and it hasn't worked? Well, I want to walk through an example with you to kind of show you the principles of how averages and how they come to an average rate of return, and why you accomplishing an 8% average rate of return has nothing to do with your ability to create wealth. So here we go. So year one, you have $1,000, and I'm working in really small numbers just to talk about a principle, but you can make this $100,000 and it'd be okay. But let's talk $1,000. Let's say, principally speaking, is a big extreme, but in order to push across principles, you got to talk in extremes typically. So you got a negative 50% year. So what happens? You have $500 left, right? So you're not very happy, right? But however, year two comes and you have a huge rebound. We have a rebound. You start with $500 because that's what you had left after year one in your account. You have a big rebound, the biggest recovery the stock market's ever seen. And in 1 year, it regains all of its losses. And so what do you have now? You're back to $1,000. So my question to you is, what's the average rate of return? Most people that I talk to, in fact, probably 99 out of 100 people I talk to say, well, the average rate of return is 0, right? Because I started with 1,000, I ended with 1,000. Well, that's not the case. Most people say 0, but if you look at the numbers, you say you had a plus 100 year minus a 50 year, that gives you 50 divided by 2 years. That means your average rate of return is 25%. Your real rate of return is 0. So do you care about your average, or do you care about your real rate of return? Do you care about how much money you actually have in your account? Because the average rate of return, your 8% that you've been told you can bank on for an average rate of return, that may be true. I'm not saying you can't get an average rate of return, obtain an average rate of return over your working career of 8%. I'm saying it doesn't matter. And if this seems a little awkward or out there or whatever, let me give you one more example. So in this example, it's going to be basically the same thing. It's saying year one, you start with $1,000, but instead of losing 50% the first year, we're gonna gain 50%, right? So check this out. You gain 50%. What do you have now? You got a 50% gain of 1,000 is $500, so you're left with $1,500. Now year two, here's the crazy part. Year two, you got $1,500 to start the year. What do you have? You have negative 50 happens now. So we had a plus 50 year, a negative 50 year, right? And we have $750 left, right? So that, stay with me here for a second. You could say, what's the average rate of return? Well, you can look. Most people say it's negative because I got $1,000. I started with 1,000 and now I have 750. So most people say it's negative. Well, the reality is you got a plus 50 year and a negative 50 year. 0 divided by 2, well, 0 divided by anything is 0, right? So you have a 0% average is what most people think. But the reality is that, I'm sorry, your average is actually 0. That is what your average rate of return is. However, your real rate of return over those 2 years is negative 25%. Now, you could break that down. The annualized rate of return is going to be like negative 12 or negative 11 something percent. But the bottom line is 25. If you look at the average versus the real return, what I'm trying to convey to you here, what I want you to understand is that the average rate of return means absolutely nothing to do with your ability to create wealth. And the most important element of you accomplishing wealth in the way that you want to is to avoid negative losses, because when you have a negative in your account for any reason whatsoever, whether it's fees or losses, market drops, whatever, mistakes on your end for spending, it interrupts compounding and it takes more work to get back to even, right? If you lose 50%, you have to earn 100% just to get back to even. So that's why average rates of return have nothing. And to me, it's completely unethical that financial advisors are even able to talk about average rate of return at all. So you remember the slide a couple slides back where I had the graph and it showed the $1,000 to $1.25 million, but it actually wasn't $1.25 million. It was about $64,000 after fees and all the ups and downs in the markets. Would you be my friend still if I was the person who came to you and said, "Hey, like give me $1,000, I'll turn it into $1.25 million," and then 80 years down the road you only had 64,000? Right? Probably we wouldn't be so tight after that was all said and done. So the question is, where'd all the money go? Right? If it disappeared, where'd it vanish to? Well, the ups and downs of the markets obviously are what they are, But that's $235,000 is what it said based on the ups and downs of the markets. You should have $235,000. So there's a big gap still between $235,000 and $64,000. Now, here's why. Well, the average rate of return since 1925 is 8.36%, but the real rate of return is 6.33%. That's why you go from $1.25 million to $235,000, because the real rate of return at 6.33% is nearly 25% less than 8.36%. But the bottom line is this, is that when you compound that 25% almost difference over a long period of time, it adds up to a lot of money. You end up with about a fifth of the money that you should have, that you would have, I should say, expected to have, which is a big problem. Now, you go from 235 all the way down to 64 because you have mutual fund fees and you have advisor fees. And you can see here that the mutual fund fees are 1.1% on average right now across the country, and advisor fees average about 1%. So if you combine the two together, you have a 2.1% average that you're paying in total fees just for your own money. Now remember, you're only making before fees 6.33%. Wait. So you're telling me that after fees and expenses and everything, that you're only getting 4.23% after fees and expenses? That is exactly what I'm telling you. And I'll tell you right now, I hear this all of the time, and people don't get it. They're like, I don't understand why the market is doing so well. I don't understand when I look at my statement that I get in the mail every quarter. I don't see why the market's doing so well in my portfolio. My account is not keeping up with what I expect based on what I see in the news and based on when I talk to my friends, and like, why is it not working? Well, I just told you the answer right there. And if it's still confusing after this point, please give me a call. I'm happy, or I should say, don't call me because my phone will be ringing off the hook, but send me an email. I'm happy to send you some good information that can take it down another level. But this is the key to understand why you're not achieving whatever goals you want to achieve, why your money isn't working for you the way you thought it would. And what I'll tell you is it gets even worse. Because remember, the real rate of return since 2000 has been less than 1%. And that doesn't even account for advisor fees, for mutual fund fees, which will bring you into the negative. So you actually, after those fees, have a negative performance in your accounts over the last 15 years. And that doesn't take inflation into account. And if you take a 2% inflation rate since 2000, you're looking at, you've lost probably 30% of the purchasing power of your money at least during that period of time. Plus you've had negative returns. So it's no wonder that people this day and age are feeling like they can't make it work. And that doesn't even take taxes into consideration. So when you add in the taxes that you have to pay on all the earnings, or the taxes that you want to access your money, it makes it even worse, which is almost unfathomable, I should say, to conceive. And I'll tell you right now, the biggest killer of creating long-term wealth is interrupting compounding interest. And Albert Einstein said it best when he said, compounding interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. And with as much debt we have as a nation, with as much consumer debt as we have right now, it's only a matter of time before this bubble pops and we can't deal with it. There's got to be a massive deleverage situation that happens, and it's going to happen pretty soon, because you can only manipulate markets for so long. That's the reality of the situation. We're in a situation right now where we have quantitative easing, QE, and we have cheap money that can't last. I mean, we're in an environment right now where we have the lowest interest rates in the history of this country. Not only are they the lowest interest rates we've ever had, but we've never had interest rates even close to as low as we are right now for more than a year. And we've been here for 7 years now. So we've been just feeding and living off cheap money. This has been one of the greatest, if not the greatest, financial experiment of all time. Markets are extremely overvalued because of this experiment, and it's just a matter of time before it ends. All right, hopefully by now I've sufficiently woken you up to the reality of what's going on in the economy, what's going on in the stock market, what's going on in your accounts, why you are frustrated with your results and you haven't known why. Well, now you know, right? And now you know. And the one thing I don't want to do is just scare you and leave you be and leave you with no solutions. And so what I want to do now is I want to talk about some banking principles. And these are principles that you absolutely need to learn in life if you want to be successful with your money, because I'll tell you what, we are living through an environment right now where interest rates are at all-time lows and banks are making record profits. And how are they doing that? Because they use certain principles. Now, the first principle that they implement in their business models is they use leverage. Now, most people think of leverage as debt, but ultimately what leverage really means is leverage is using somebody else's money to build your wealth. And that's really what leverage is. And banks do this by using the fractional reserve banking system. And that's simply saying, hey, listen, if you give the bank $1,000, they can lend out 900 of that. They could just create it out of thin air. They lend it out. And then if that person then takes $900 and deposits it in an account, they can then lend out 90% of that. And then that person, and it goes on and on and on. At the end of the day, somebody, if for every $1,000 deposited in the bank, they can create $10,000 out of thin air. And that is a massive, massive problem. And I say that's a massive problem simply because it's a problem for you as the consumer. For the bank, it's awesome. It's leverage. It creates profit for them. So what I want to do is I want to show you how to do that. And the banks do this in stage by creating velocity. Now, that sounds like a pretty crazy word when we're talking about money, but velocity means what you think it means. It means speed. And it means the faster that you can move your money, the faster that you can get your money to work for you, the greater your chances of creating wealth quickly will be. And what I mean by this is volume is the name of the game, right? It means try to get your money in and out and in and out, in and out. Use your money to pay for investments, for cash flow opportunities, pay them down, recapture money, repeat the cycle. And the faster you can repeat that cycle, the more beneficial you'll be, the more you'll be able to benefit from the velocity of your money. And the banks use a lot of fractional reserve banking to accomplish this, but you can use certain principles to implement the leverage with your own money, with your own banking system. That's what abundance banking is all about. You can then use that to create velocity and use the access to that money to get your money working for you more efficiently, and you can start creating and turning that over on top of each other, and it just becomes absolutely the most powerful financial vehicle that you will ever imagine. And I say that because if you do it right, you're going to create more cash flow, right? And the more cash flow that you have, the more you can leverage that cash flow to create more, right? It becomes a cycle. You leverage, you get velocity going for you, and it's like it gains momentum, right? It's the more it starts to roll, the faster it starts to build, and the more momentum you create. And it takes a little while to get going, but once you get the process going, once you've saved and you've capitalized your bank, and once you have everything where you need it to be, then that more cash flow comes in, it starts to stack on top of each other, and the cycle repeats faster and faster and faster and faster, and you create more and more and more wealth and more cash flow, and all of a sudden, you don't even care what your net worth is because you have so much cash flow coming in that's what life is all about. And if you want true financial freedom, cash flow is where it's at, because if you structure your cash flow properly, you could have a net worth of zero, but do you really care if your cash flow coming in is tens and tens of thousands of dollars or even hundreds of thousands of dollars every month or year? However, whatever you are, whatever your goals in life, cash flow is the only way to solidify your financial standing and give you financial freedom. All right, so that's all fine and good, but the challenge is how do you take that information and actually apply it in your own life? Because it's one thing to learn principles and concepts. It's another thing entirely to learn how to apply those principles and concepts into your own life and create action. And so what I want to do is I want to kind of give you a story of two families, two just massively successful families that I think you'll be able to relate to, and it'll give you a story of what I want for you, where I want to be able to see you moving forward. And this is a big thing that made an impact on me based on what I want for my family. And I think it'll make a lot of sense to you in just a second. So let's take Cornelius Vanderbilt. Most people are aware, if not the man, at least the family. And the reason is because Cornelius Vanderbilt was the richest man in modern history. When he died in 1877, he was worth $108 million. Now, that may not sound like a lot of money. At that point in time, $108 million was worth the equivalent of what $220 billion is worth today. $220 billion. To put that into perspective, Warren Buffett, Bill Gates, they're fighting for world's richest man title right now, and they're roughly in the $75 billion range. So just to give you an idea, Cornelius Vanderbilt was worth roughly 300% more than Buffett or Gates, right? So here's the challenge. In 1972, by literally 5 generations later, 95 years, 1972, there wasn't one single millionaire left. Why? Because Vanderbilt didn't pass down a system. Vanderbilt didn't pass down principles. Vanderbilt just created. He was the secret. He was the system. He was obviously a massively talented person, but it wasn't duplicatable, right? And when he died, his family didn't learn anything from him. Obviously, if they did, then they'd still be there. They'd be wealthy. There'd at least be a couple millionaires left. There'd be at least be a couple successful people left. And the challenge is that they didn't do that. And so literally not one single millionaire left at their family reunion when they had over 100 people there. And it's just one of the saddest things I've ever seen, to have that kind of wealth just squandered over a 100-year period. Now, on the flip side of that, you have Amschel Rothschild. And most people have heard of the Rothschild family, maybe not the man himself, but this was the guy who created that legacy, that whole Rothschild family. And he was a banker. He died literally almost 65 years before Vanderbilt died. But he was a banker. He wasn't a businessman. He was a banker. And in that banking world, he learned the principles and how banks made their money and how they created wealth, how they created leverage, the 3 principles of banking that I told you before. He took those principles and he applied them and he taught them. And unlike Cornelius Vanderbilt, even though Rothschild didn't amass the wealth that Vanderbilt amassed while he was alive, he was still a well-to-do man. He then left a banking system for his family. And when he died, he left 3 rules for them. And it's key to note that those 3 rules inside of this conceptual bank, and the conceptual bank part here is the key to understand, because they didn't hold their money necessarily in a bank account. They kept their money in a way, and they used that money and implemented principles in the same way that a bank would use those principles. So he set up a fund for the family, and that family had access to that money. If they needed that money, they could take a loan for opportunity, for a business opportunity, for real estate opportunity, any opportunity that would create cash flow. Anybody in that family had access to that money. However, they had to pay that money back with interest. Why? Because if they took that money, they had to pay back with interest to create more money in the coffers, to create more opportunity for the family. It's a principle, just like the way banks function right now. Banks grow, the more they lend, the more velocity they create, the more money is paid back and they earn an interest. That money coming back in creates more velocity. They can then lend more money out, and the compounding growth just gets faster and faster and faster and faster. And access to capital is ultimately what creates wealth in this situation. And so he took this principle and created a system that his whole entire family was able to implement and use. Now, rule number 2 is simply saying, okay, if I'm going to give you access to this money, any knowledge that you're to gain in your business, with any business venture, with anything, needs to be shared with the family. Now, that may sound like back, especially in the 1800s when this first happened, there were no cell phones, there was no communication, it was really tough. That's where he made it so they were required to have annual meetings. And what I'll tell you is they're still having annual meetings to this day. Now, the difference here is there's a lot of wealthy families that have annual meetings to discuss their family values and the principles and what they're doing for business, and how they're going to use the family funds to distribute in business opportunities or whatever. But the difference here is that they used this money as a system. And not only are they using the meetings to talk about what to do with the money, they're talking about why they're using it and what they want the money to do for them, and how they can create not only how they can continue to create more wealth for themselves, but keep it going for generations to come. And so my question to you at this point in time is, how many of his family members, of Amschel Rothschild's family members, are millionaires to this day in 2016? The answer is all of them. Every single person in the Rothschild family is born a millionaire. Now, you compare that to the Vanderbilt family, who was the richest, went from the richest position in the face of the earth to having no millionaires. Compare it to here, where every single person born into that family is born a millionaire. And because of the principles that they use, it will only get better and better and better. And that family will only have more and more and more opportunity. Now, there becomes a point in time, obviously, where you don't need more and more and more. But what I can tell you is, when you have that kind of money, you can make the world a better place. And that is what it's all about, in my opinion. So the question at this point in time is, how do you get your money to work for you? How do you start leveraging your abundance bank and get this system to work for you? And the first phase is really capitalizing your bank. Like anything, you need the money. You need to be able to save up and show that you have the ability to save before you can go out and create, right? Because you don't save wealth, you create wealth. And the key thing that I want to point out before getting into all this is that your abundance bank, people compare these to investments and stuff, and the reality is that they're not investments. They are, the abundance banking concept is simply saying, what is the best, safest vehicle to use as a storage tank, as a holding tank for your money? Now, when you do this, you capitalize your abundance bank. You simply are saving and storing that money up. Why? Well, because you're waiting for an opportunity. You're waiting for the right time. You're looking for assets that you can wait and invest in, where you can make 50, 60, 70, 80, 90, 100, 400% rates of return on in very short, small periods of time within a couple of years. And you can't do this if you're buying when the market's at an all-time high. You can't do this if you don't time it right. And I think that's where people get a lot of things wrong when it comes to the markets and timing. There's this negative connotation to timing the market, quote unquote. And really what it comes down to is, yeah, if you try to time the market on a regular basis, you're going to get burned. There's no way around it. You're going to get caught with your pants down and you're going to be stuck. However, if you simply keep your money safeguarded until the timing is proper, well, if you wait for the market to crash, well, that's when the most opportunity is. And you know it's going to come. And if you wait for the market to crash, well, how hurt can you get, right? It's like I tell people all the time, you're a lot less likely to buy a house for $60,000 or $70,000 that was selling for $300,000 6 months prior, or a year prior. You're a lot less likely to get burned at 60,000 than you are 300,000. And so it's all relative. And the key is capitalize your abundance bank first. When that house becomes available, when that rental property becomes available, when that business opportunity becomes available to you and you can buy it for pennies on the dollar, you take a loan against your own abundance bank. You leverage the banking position. And then what do? You got that asset now. That asset is going to be kicking out cash flow. And because you were able to buy it for a song, you are able to cash flow, hopefully very efficiently, really quickly. Now, what do you do with that cash flow? You take a lot of that cash flow, you put it back into the asset, and it starts to accelerate the growth. You put that money back into your asset, you pay interest to your abundance bank, you recapitalize your fund, your account, and it grows and it grows. And now next time you try to buy another asset, you have more money in your abundance bank, and it just compounds on top of each other. And then the next cycle you go through, it does the same thing. You have more money. And the hardest part is to do it for the first time. Once you go through one cycle, it just starts to gain momentum and speed up. And so hopefully that makes sense, but I wanted to give you this visual to understand that. And as I said, you want to be buying cash flow creation assets. And the one thing that I want to focus on here is the cash flow creating assets. However, that said, you can also take loans for automobiles, for cars, for houses, for college, for your kids, for vacations, for really any kind of major capital purchase, anything that you can't imagine that most people wouldn't pay cash for. And I'm going to teach you in the future on how to leverage your abundance banking account to do all that. And that will help you operate more efficiently. That will help you recapture a lot of interest that you would normally transfer to the bank, so to speak. But if you really want to create wealth and accelerate your wealth potential and your ability to just really create long-term lasting wealth beyond most people's like ability to even conceive, really using this system to buy cash flow creating assets is what it's all about. And one of the things that I hear a lot is, okay, that's fine, Chris. I can save money. I can put money aside. And that's not my concern. My biggest concern, and the reason I have my money in my 401k and my stocks and my mutual funds and all that stuff, is really because I just don't know where to look for opportunity. I don't know how to find anything else. I really have no clue where to look. And so this is just a list of some potential investments that people have. It's definitely not limited to this list. It's think about what your skill sets are. Now, the one thing I will say is that I do have of an affinity, I'm going to say, to apartments, to cash flow real estate. Now, I'll tell you that maybe not the case for your specific area, but we do have a program, and you should be looking at the interview that I did with this guy, Mike Wolf, who's in this course. Watch the interview, because that interview will change the way that you think about cash flow investment for real estate. And the reason I say that is because with apartments, or if you buy cash flow single family homes, the one thing I could tell you is I know a lot of people that have lost their shirt during 2008 in real estate. And this one guy, Mike Wolf, he has absolutely I should say, he was able to double down. He was able to prosper and thrive in that environment simply because of his real estate investment strategies. And it has more to do with where he's buying and all that than anything else. And most people think that if they get invested in real estate, they're kind of stuck to their backyard. But Mike really takes that barrier out of the equation. I know in Vermont, where I'm from, honestly, real estate's not a good investment. And wherever you are, real estate may not be a good opportunity for you, but there are always good pockets. There are always opportunities in certain areas. And what Mike does is he finds these opportunities. And I can tell you that I would really look into following a Mike Wolf. You can go to Mike Wolf Mastery. You can watch the interview that I did with Mike on this, and he has just a wealth of knowledge. And if you have any affinity towards real estate, or if you're in a situation where you don't know what to invest in, and this, I can tell you, is just a hands off. You got to be educated about it to a certain extent for sure, but once you understand it, it's very simple. It's very easy to understand. It cash flows immediately year one, and you're in a position, I should say, where you can then get your abundance bank really moving. And it's very predictable with Mike Wolf's system. And that's why I love it so much. And so if you're somebody who's falling back saying, I don't really know where to put my money, I would really suggest looking at this system and looking at how to build your abundance bank to actually start them flowing your money into that system. And here's what I can promise. Start this soon, because the real estate crash 2.0, like we had in 2008, it's coming, because the market rebounded on cheap money, on printed money, and the fundamentals have not been there. And as interest rates start to rise, as demographics go down, as you probably heard me say if you've been watching this course, you understand what I'm saying, that there is going to be another correction. So by saving and getting your abundance bank built quickly, you're going to be set up for a lot of opportunity. And just as a little side note, one of the things that I want to talk about real quick before I get into what you look for in your abundance bank is, I get asked a lot of people, is like, why do I want to do this? Why would I want to put my money here rather than put it in the stock market? Now, if I haven't kind of made that abundantly clear at this point in time, the real reason that we're doing this is to create wealth, right? And the challenge is, the only really pure way to create wealth is to put your money into a position where you can earn uninterrupted compounding interest. And you're never going to be able to do that by putting it into accounts where you're just buying in all economic environments. You just don't do it. Nobody who is wealthy just throws money into investments regardless of the economic environment. It just doesn't happen. So think and act like the wealthy, right? That's the first step. Now, the second step is, no matter what happens, you need to fight inflation, right? Because inflation is one of the greatest wealth killers. It's one of the greatest hidden taxes, especially on the middle class. And it's because of inflation that people are held back. If you are 35 years old today and you make a $40,000 a year income, you're going to be needing $100,000 a year to maintain your standard of living when you retire based on inflation. So it kills your purchasing power. So you need to understand that. And so that's why the abundance banking system is so vital in your financial success, because not only does it help you create wealth, but it helps you fight the negative effects of inflation in your financial life. So the question that I ask everybody is, what do you want your money to do for you? Because if we're going to look at money as a tool, which if we want to be successful, that's all we need to be doing, is looking at money as a tool to get the job done for us. Well, you don't want to bring a saw if you need a hammer, right? And that's the biggest thing. So what are we looking for our money? And so I want to look at some characteristics that are absolutely vital. So is your money safe? That's the first and foremost thing that we need to build our foundation of safety. So first and foremost, is your money safe? Before you put your money into a risky situation, are you safe? Because if you're not, you can't take the risk. Is it highly liquid? That's a very important element to this, because there's a lot of places you can keep your money safe, but it's not always liquid, right? You can put your money into bonds, but if you do that, a lot of times that money is tied up. Are there no penalties to access it, right? A lot of times people say, yeah, I can get to my money, but you're going to need to pay penalties or taxes or whatever to get to it. So can you access that money with no penalties? And are there tax advantages? Are there tax advantages to what you're doing? And what I mean by that is, will your money grow tax deferred? Will you be able to have access to your money tax free when you want it, for whatever reason that you want it? And the key is you've heard me say, are taxes going up or down, right? A lot of times it makes sense to just pay the taxes now while we're in a low tax rate environment and kind of go from there. But you want to make sure that you're not going to be set up with a tax bill year after year after year in the account that your money's sitting in. That's absolutely essential. Now, do you have guaranteed growth? Now, I'm not talking about the guaranteed growth that your bank will give you at 0.5% or 0.1%. I'm talking about growth that will guaranteed over a long period of time, over a 10-year period of time or so, beat inflation. All right, do you have that? And is this account not going to be impacted by the stock market negatively, right? I want to put you in a position that no matter what the stock market does, you're protected. If it goes up, you're gonna be okay. If it goes down, you're gonna be protected. And so that's the biggest thing. Now, if you have these characteristics, the question is, these are the characteristics, if they're the characteristics that you're looking for, if these are what you're looking for, what account can you put them in? Well, let's talk about that a little bit. So I'll tell you what won't work before we get into what will work. What won't work are mutual funds, right? Because those are risky. They're up and down. CDs won't work because your money's tied up. And a lot of times right now, CDs aren't even beating inflation. IRAs, 403Bs, all the above, your 401ks, none of that stuff is going to work because you don't have access to the money without penalty or taxes, or it's not liquid, or it's not beating inflation, or there's just too much risk. So the bottom line is, all the places that people typically tend to start their financial savings in their life, their investments, because they're investing before they save, they got it backwards, right? And because of that, these are definitely not the places that you want to start. And that's one of the reasons I believe that Americans are so backwards and are in so much trouble when it comes to their savings. So that's why I love the abundance banking system, because it is absolutely essential. If you want to be successful in your finances, you need to learn to save before you invest. You need to learn that you need to prove that you know how to save, you know how to be disciplined with your money before you go out and start taking swings for the fences with investments and opportunities and whatnot. Because if you start trying to take too much risk too soon, I promise you're going to get caught and you're going to be stuck and you're going to lose lots of money, tens of thousands of dollars, if not hundreds of thousands of dollars, before you actually start to get it right, because education in this world can be expensive. So prove that you have the ability to save first. Now, this is why I love the abundance banking system, is that it is absolutely the safest place to put your money. And I'll tell you what it is here pretty shortly, what the account is, but I want to explain to you some of the benefits of the account, because I think once I tell you, it's going to blow your mind a little bit as to what it is. It's at least going to throw you off kilter a little bit, and you're going to be like, whoa, is that really the case? So it's the safest place in the world for your money. Why? Because the FDIC is massively underinsured. They have something like a couple $100 billion insuring multiple $1 trillion worth of assets. So it's really, if the FDIC really, if we have a banking crisis, the FDIC is underinsured and they're going to need to be bailed out. And what we do is we only work with companies that are A-rated and have successfully paid dividends every year for 100 plus years. So I'll explain more on that a little bit later. And this includes, folks, this includes times during the Great Depression and every recession since. Like, this is the biggest thing to think about here is you want to work with companies, you want to keep your money in accounts that have been guaranteed, that have proven that no matter what happens in the financial world, that your money is going to be protected and safe. Now, the reason that we work with the companies that we work with, and you don't have to work with us, I want to make that abundantly clear, for lack of a better phrase, is that you don't need to work with me. You don't need to work with my company, with Life 180 or with us, but you need to do this. You need to be thinking about where can you keep your money safe, and you need to work with companies that did not take TARP money. Now, it's the TARP. If you don't know what it is, it means they didn't get bailed out in 2008. TARP is an acronym for Troubled Asset Relief Program, and there's a lot of companies, a lot of financial institutions, including investment banks, that got bailed out, and those are not the places that you want to keep your money. And once again, the Abundance Bank, for characteristics of your money, it is just a holding tank for your money. And what you need to be thinking about is, as a savings vehicle, not an investment. When you want to invest, you invest in other things. But as a savings vehicle, you're talking about a 4.5% rate of return when structured properly, right? That's over a period of time. You're looking at a 4.5 long-term rate of return compared to like 0.1%. This is roughly 40 times higher than you're going to get in a normal bank account. So it's kind of a no-brainer when you look at that. And these results are 100% guaranteed. You're going to have guaranteed growth. Now, how does this compare to your current savings plan? I just want to ask you that. If you got your money in a bank account, it's at least 4.5 times higher if you have a high interest return savings account, I should say. But for most people, this is going to be 40 to 45 times higher than the interest they're currently getting in their savings account. So if you have that, my question to you is, are you going broke slowly? Is that you? Because once again, if you're earning that low interest rate, if you're earning lower than inflation, you are growing broke slowly. And the reason people do that is because they think, I need access to my money. I need to have it safe, right? All the characteristics that we thought about. But my question to you is, are you trading your wealth potential for security? And if you're doing that, you don't need to. One of the keys also for your Abundance Bank is that you need to make sure that it's highly liquid and that it's penalty free, right? Because if you have your money in your 401k, your qualified accounts, which is where more than 80% of money that people are currently saving for retirement is held, you don't have access to it without paying a penalty or taxes or whatever. And so, have you ever had a situation where you need access to your money quickly? Have you ever had to pay a penalty for accessing your 401k earlier? I have a friend who just started a new business, literally. He needed $42,000 to start his new business. He didn't have it saved. He didn't have it accessible. What did he do? He had to take it out of his 401k. And when he took it out of his 401k, he had to take out over $80,000 just so we could have $42,000 after taxes and penalty. And that alone right there, that just cost him a fortune, right? So that is something really key to think about, because it's your money. You want to be able to use it when you want it, how you want it. If you want to start a business, if you have unexpected medical expenses, etc., it's no matter what the reason is, you want to make sure that you have access to your money. As I said before, you need to make sure that you have tax advantages, right? The money that you have, you want to make sure that it grows tax deferred and that you have tax-free access to your money now and later, right? The reality is that taxes have nowhere to go but up, right? It's like I always say all the time, is delaying taxes is like delaying a trip to the dentist. The longer you wait, the worse it's going to get. There's no avoiding taxes. The question is how can we minimize your tax liability over your life? And for most people, you're not going to have more tax deductions when you're older. You're going to have more tax deductions when you're younger, because hopefully, because of inflation, if nothing else, your income is going to go up as you get older. Most likely, you're going to have more deductions now also than when you're older, because the reality is you have kids now, you have your mortgage, you have all these different things going on in life that give you deductions that you're probably going to lose out on as you age. And so if you know that your taxes have nowhere to go up, why would you delay paying them until later? And on top of taxes, the other thing that you need to make sure is that whatever money you're saving in a safe account where you're storing and waiting for the opportunity to invest in is not impacted by the stock market. Because when you do that, you actually bubble proof your life. You make it so when everybody else is being hurt by the bust of the stock market or the real estate market or whatever's going on in the economy, it could be a student loan bubble burst. It could be one of just a plethora of things going on in the world right now that just we have no idea what's going to happen. So keep your money safe against that. And because if you're afraid of the fact that, there's a lot of Wall Street corruption going on, you're not in control of what's going on with your money. There's a lot of unpredictability in the market. And if you're scared of losing everything that you've worked so hard for, it's absolutely essential that you build your abundance bank. Can you imagine getting all these benefits that we've talked about to this point in time? So what I'm here to do is I'm here to tell you that yes, it is possible. You may not think it is because you've been told a lot of other things, but not only is it possible, but the reality is that there's only one place where you can achieve all of these benefits. And that place is in a properly structured whole life insurance contract. All right, so I'm going to get real with you real quick because the reality is you may have been told differently. You may have been told that life insurance is a terrible vehicle to invest in. Or maybe you're on the flip side of that, or maybe you just never thought about it. And it's not anything that's ever crossed your mind. The whole idea of saving your money in life insurance is just so outside the box that it never crossed your mind to think of. And the reality is, here's why. Because most insurance agents and financial advisors simply don't know about it. And if you Google it, you're going to find lots of negative stuff. You're going to find people like Dave Ramsey and Susie Orman slamming on life insurance because the reality is that A, they don't know what they don't know, and B, why they don't like it is because most insurance agents don't know what they're doing. So you can get caught in a lot of traps. You can be put in a situation where, hey, insurance agents sell it and they make huge commissions. In order to do this right, you have to the insurance agent really has to have the client's best interest in mind. They have to make massive, massive, massive commission cuts. And that is the key here. Now, on the flip side, you're also going to find some positive stuff. You're going to find people like Robert Kiyosaki who understand the power and the leverage and the benefits of life insurance. You're going to see people like Robert Kiyosaki now who use this strategy, who use life insurance as the tool that it is to accomplish what they want. Now, if you know who Robert Kiyosaki is, I'm telling you, he's one of the most successful real estate people in the world. He wrote the book Rich Dad, Poor Dad. He is the type of person who, if you're an entrepreneur, you need to be following his advice. And that's all I'm doing is I'm learning from people like him. And I want to share that information because there's so many people out there, the Robert Kiyosaki's, the Grant Cardones, the Gary Vaynerchuk's, the Brennan Burchards, all these people in the world who teach people how to go out and build their businesses, how to go out and sell, how to go out and create. But when it comes to the technical money stuff, nobody's telling you how, where, how to save your money, what to do with your money. And so that's what my passion is teaching people not just what to go out to sell, how to build a business, all that, but what to do with your money once you are successful. And Walt Disney created Disneyland using this strategy. Ray Kroc created McDonald's. Stanford University was created using this strategy. I could go on and on and on and on about people throughout history who have used this strategy. The Rothschild family. If that doesn't tell you all you need to know, I don't know what to tell you, but this strategy just flat out works and the most successful people in the world are using it. And to back it up, the reality is that banks just flat out understand this because banks are the largest purchasers of cash value life insurance in the world. And there is a reason why whole life insurance is considered a tier 1 asset on banks' books. Now, this is all public information. banks are publicly traded for the most part. They're public organizations. So all of their assets are completely public. And a lot of banks have as much as more than 40% of their liquid assets inside of these life insurance contracts. Now, that is money that they have access to. That is money that they use as a reserve to make sure that their bank is stable. It's a tier one asset. A tier one asset is the most stable asset in the entire world. And if banks are using this asset to create stability and functionality in their businesses, don't you think that's something that you would want to do in your life? So what you do is you give up a little liquidity in the short term, and there's no way around that. You're going to give up liquidity, or you're going to have some risk to take on any level. So rather than take risk, what I'd say is don't invest and take risk. Give up a little liquidity in the short term, but you have a massive, massive leverage tool where you can gain long term. So why else would banks do it? On top of the fact that it's a tier one asset, the historic rate of return on this is a 5 to 6% rate of return. That's a real rate of return after fees, after expenses, after all your insurance expenses. And what that does is it beats the market after all your fees with no risk, right? That beats what's going on in the stock market. That beats like pretty much anything you could do long term after your fees. And there's no risk. Not to mention you have liquidity, use, and control of that money. You have access to that money if you need it for any sort of opportunity. All right, so I do have a couple rules though. These are absolute, steadfast, ironclad, do not break rules when it comes to investing or saving, I should say, in a life insurance contract. Now, rule number one is you only work with a mutual company, because when you own a policy, a life insurance contract with a mutual company, you are essentially a shareholder in that company. The same way that if you owned a public stock, you would be paid a dividend if it were a dividend paying stock company. When you own a life insurance contract, a whole life insurance contract with a mutual company, you get paid a dividend the same way every year. And so we only work with companies that are 100 plus years old, and we only work with companies, and you only buy contracts with companies that have never missed a dividend. So think about that. If the company is 100 plus years old, and this is why I suggest this, if they're 100 plus years old and they've never missed a dividend, then that means that they've paid dividends even through the times like the Great Depression, right? And so this is on top of the 4% guarantee. And when you add all that in together, that's why we suggest that. And so the last thing, and this is the crux of everything, that this kind of brings everything together, is that you only should do this with somebody who has experience putting these together. Now, I'm not the only one out there who's doing this, so I don't want you to think that you have to come work with me. I'm happy to help you out. My organization is happy to help you out. I have certified financial coaches with Life 180 that I have taught to do this, that can help you with your specific position and whatever your life is looking like, however you need to navigate your financial position, we can help you. But what I want to tell you is that you can go work with almost anybody that has experience putting these together, but you just need to discern who that is. You need to make sure you ask them all the right questions before you actually make the decision to move forward. Now, there are two major misconceptions when it comes to this, and this is really essential to understand because Dave Ramsey's got it right. Life insurance is a terrible, terrible, terrible investment. People compare life insurance to an investment vehicle, and well, in reality, it can compare. It can hold its own water. It can hold its own weight against most investments over a long period of time. And when you tap on the benefits to it, yeah, it's great, but it's not an investment vehicle. It's a savings vehicle. It's a holding tank. It's just a place to keep your money safe, to beat inflation. Most of the time, it's going to compete long term with investments, but it's really not the investment. It's a safe account that you have access to that you use for investments when you want. Now, the next one, I just kind of touched on it last slide a little bit, but most people think that any whole life policy will work, right? That was what I was saying. Don't work with just anybody. Make sure that they understand this. And there are a lot of companies out there that sell whole life insurance policies. There are certain companies that focus and do this properly, that actually have the certain riders and have the certain ways that you're able to structure these policies to make it beneficial, to benefit you. And the reality is, like I said, very few agents know how to construct these policies because very few agents work with the companies that actually do it right. Now, just kind of like on a side note, I wanted to throw out there is if you want to do this and if you're wondering like how do I do this? I can't make it happen fast enough. I don't make enough money. I can't save enough money fast enough. I just want to make this happen. Well, do it as a family, right? And what I can suggest to you is if you can find a business partner, a family member, multiple family members, multiple business partners, you can structure this. You can make this work and you can accelerate it. Get in, start a business, do it. I've seen people do this before, and it is amazing when people come together and start using this abundance banking system, looking for opportunities and starting business. And if you put your heads together and you make it work, I don't know, it's something that maybe this isn't for you, maybe that's not for you, working with other people. But if you think time is of the essence and you want to accelerate it and you want to make it work faster, you want to really leverage the power of what this can do for you in a down economy, I'm a big believer a down economy is coming. So position yourself very quickly by doing this. So this is my mission in life, folks. This is what I love to do, and I'm an entrepreneur at heart. I love to do other things. I love business. I love building things. I love helping people. But the reality is I can't tell you how often I see that people are struggling, and the system is rigged. And people, I think, have a sense of that, right? Bernie Sanders is being successful in his run for a reason. Donald Trump right now, as I'm filming this, is going for president in the Republican uh, candidacy right now in the primaries, and both of those candidates, if you were to tell people 5 years ago that those two were going to be the two that were two of the three people that were really pushing for the presidency, people would have laughed at you. And people are starting to get a sense that the system is rigged now to a level that we couldn't even fathom before. And it's because of that I have a passion, because as much as the system is rigged, the reality is you can create a financial system where you kind of circumvent normal finance and you can succeed anyway. And that's right there. That doesn't sound possible to most people, but I'm telling you that it is. And I could show you a way that can be done. Not only is it possible, it's 100% predictable. And you can achieve everything you want to achieve. And you can learn to thrive when others are struggling. You can learn to just succeed no matter what. And all you have to do is you have to have a long-term vision. You have to learn to start with the end in mind. You have to come up with a plan, and you have to be willing to put the time in and work and structure your life to make it happen. Now, you don't need to work with me, right? I'm not saying this is not meant to be a pitch to work with me. I do this because I love this. I do this because I'm passionate about it. Whether you work with me or not, you need to find somebody. You need to find somebody who does this type of work, somebody who can help you build your financial foundation. Think of saving first, think of positioning your life in the ways that I'm talking about. And I'm not the only one. So like, hey, if I'm not your cup of tea, I'm okay with that. I have thick skin. You're not going to hurt my feelings. I'm even happy if you want to call me and you want to tell me you don't want to work with me, give me a call. I'll point you in the right direction. There are plenty of people that are not really online that I know that I could connect you with, whatever. Even if you're just looking for more information, I'm all about education. Some of this stuff can be hard to find, but when you find it, it's amazing. But you need to find somebody to work with. Finally, you need to use your money as a tool. That is the theme of my life. That is the theme of what I teach. You need to use your money as a tool if you want to be able to create true wealth. And that is the most important part of this whole thing. And that is what I try to teach people. And I hope that's what you've gotten. That's what you've been able to take out of this webinar. And like I said, if you have any questions, please, 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 please get in touch with me. And I can't wait to connect with you. Hopefully we've connected already, but if we haven't, please circle back and connect with me or somebody on my team, and feel free to ask any questions that you have. As always, if you have any questions, email roadmap@life180.com and we're happy to go from there. But that is it for this webinar, guys. Thanks for sticking in there. I know an hour and 10-minute webinar is a lot. I want to give you kudos for sticking through. Hopefully this was great information. For me, this is stuff, what you just watched is totally contrarian. It's totally against the system. But if you want to achieve 5% results, You got to get outside of that 95% thinking. You can't do what most people are doing. And so this is the unique thinking. This is the 5% thinking. So I don't care if you have to go back and take your notepad and watch this again and again and again. This is one of the most important pieces of 70 minutes of information that you may ever watch when it comes to structuring your financial life. So please circle back, watch this 2-3 times until you get it right. Thanks for being here. Until next time, live abundantly, live efficiently, live Life 180. Take care, guys.